Through data analytics, Shopify actually created Shopify Capital to lend to merchants. To select these merchants, Shopify leverages sales and inventory management data to make educated decisions about the risk-return profile of individual merchants that a bank would not be able to do. Data analytics also enhances the effectiveness of merchants. A Google Trends analysis showed that merchants reacted favorably when Shopify announced enhanced data analytic capabilities in early 2015. That's because data analytics also helps merchants make decisions. For instance, what channels are the best channels to market certain types of products?
We compared Shopify to some of its key competitors, including Magento, BigCommerce, WooCommerce, and Valuation. We conducted primary research and spoke to 34 merchants from the US, UK, Canada, and Australia, and benchmarked Shopify against its peers on the basis of 5 criteria. Overall, Shopify was ranked number 1, and we'd like to speak to more about 2 of the 5 criteria. So Shopify offers the most complete and comprehensive e-commerce platform, and unlike some of its competitors, doesn't impose any restrictions on how much revenues a merchant can make. Seeing as how the company also monetizes on the basis of overall transaction volume, it's clear that its interests are directly aligned with its merchants' interests.
In particular, there are 2 aspects of the operating model we'd like to highlight. The first being revenue growth, and the second being the scalability of the business. Both merchant and subscription solutions are expected to grow significantly as more SMBs convert to e-commerce solutions and as Shopify expands its market share due to its superior competitive positioning, which we highlighted through our primary research. In particular, merchant solutions is expected to grow at a faster pace, reflecting the fact that merchants are growing and succeeding on Shopify's platform, and consequently, they're processing a greater volume of transactions on Shopify. In Q4 2016, Merchant Solutions grew at a rate of 108% year over year, and its gross margins improved by approximately 400 basis points, which was well ahead of our expectations and was one of the key drivers for our revised valuation on a DCF basis to $72 per share.
Lastly, we've also identified some key risks with our investment thesis for Shopify. While we have identified many risks, we'd like to highlight 2 with the highest likelihood and impact. Firstly, like any technology company, Shopify is susceptible to cybersecurity threats. For example, if a denial of service attack were to occur, it could render merchant websites unavailable for varying periods of time. However, Shopify has been able to mitigate this risk in the past by having a white hat program which rewards security researchers for being able to detect these vulnerabilities on their platform. Secondly, Shopify also could fail to keep up with technological advancements. If they were to fail to do so, this could significantly this could lead to significant loss of customers. However, Shopify has been able to keep up with industry trends by continuously investing in research and development, as well as varying stages of products across their varying life cycles as well. To conclude, after reevaluating our investment thesis, we would like to reiterate a buy recommendation with a target price of $69, representing a 14% upside. Shopify's comprehensive e-commerce solution, its powerful data analytics capabilities, and its strong competitive positioning make it the gold standard for SMB services. We would like to thank you for your time and open the floor to any questions you may have.
Can you touch on your thoughts on management, governance, the board?
So I guess in terms of the management team, one thing we know is Tobias Lübke was the founder of the business and has been with it since. We think even after IPO, the fact that we have seen the business continue to grow at the rate that it has been shows that there's a strong management team in place. In addition to this, one thing that Tobias really talks about that other people like outsiders may question is the fact that he really likes to foster an entrepreneurial environment. So within the company, a lot of the people that they hire would have been CEOs of previous companies and have the leadership capabilities to take on new and innovative projects that they may pursue in terms of research and development and things of that nature. From a corporate governance perspective, we did also look at the capital structure of the company, looking at the fact that there is a dual class structure. So with Class A and Class B shares, we realized that there is a bit of a discrepancy between the composition of the share ownership and the concentration of voting control. However, the reason we don't see this being an issue is due to the fact that when Class A shares make up 95% of the total shares outstanding, all the shares will be converted on a one-to-one basis into Class A shares. In addition to this, while the voting control has been managed, a lot of the compensation in terms of stock-based compensation for these guys is longer term in nature. So we strongly believe that there is an alignment of the goals of the management team with the longer term goals of an investor who is looking to buy into Shopify.
Good afternoon, everyone. We are the Ryerson University team, and today we're here to present our buy recommendation on Shopify. We're going to begin with business overview, competitive positioning, industry analysis, and that'll be followed by valuation and financial analysis. Lastly, we'll be wrapping up with risks. We issued a buy recommendation on Shopify with a target price of $68, which represents an 8% premium over the closing price yesterday. Our recommendation is largely backed by the growth prospects for the industry, the platform's stickiness and scalability, in addition to Shopify's brand popularity and our valuation. A bit about Shopify. Shopify provides multi-channel e-commerce platform that is largely designed for small to medium businesses. Prior to its IPO on May 21st of 2015, the company was able to grow largely through the introduction of brand new services such as Shopify Payments and its Shopify App Stores.
Shopify also boasts a 4-to-1 customer retention ratio. For every 4 customers gained from competitors, they lose 1 customer. They also boast a 5.44 current ratio, which is supported by roughly $400 million in cash. This cash can be used for either growth acquisitions as well as issuing capital to Shopify Capital's partners. We can also observe Shopify's revenue growth of roughly 105%, which is a 93% premium to that of its peers. Although they do have a price to sales of roughly 9.73 times, we think it's easily justified by their tremendous revenue growth. Lastly, Shopify excels in all social media platforms, as well as Google Trends and number of active websites.
Shopify's tremendous growth is directly attributable to the company's ability to increase its customer base, which directly drives subscriptions revenue for Shopify. As a key driver for merchant solution revenue, the company's been able to increase its GMV, or the total number of sales processed through its platform. This directly correlates to Shopify's ability to acquire premium clients which use Shopify Plus. In addition to that, the company has been able to increase its per merchant monthly recurring revenue, suggesting a high platform stickiness. We believe that this trend will continue into the future, given the introduction of Shopify Capital, which presents merchants with a unique opportunity to fund working capital, scale, and expand their businesses. In addition to that, the company's been able to maintain over 100% monthly billing retention rate. We believe that this is the backbone of Shopify's business model. In addition to this, we believe that the company, as the company says, as merchants grow, the company grows with them.
We authorize a buy recommendation for Shopify with a target price of $69.30 and an upside of 14.34%. The underlying merits of our investment thesis are as follows. First, further client acquisition due to the interconnectedness of merchant solutions. Second, expansion into more desired merchant solutions. Third, the high levels of gross merchandise volume from the addition of these solutions. And finally, organic growth due to Shopify's unique value proposition. As you can see from the cone chart, Shopify has gone up more than 115% since its IPO and has outperformed the market by more than 3 standard deviations. The interconnectedness of merchant solutions mentioned as the first investment thesis gives Shopify Payments clients access to Shopify Capital, which is a form of loans issued through factoring and allows for merchant acquisition. As you can see from the bottom chart, Shopify's competitors operate in 3 main sectors: payment solutions, software as a service, and e-commerce, while Square, Wix.com, and GoDaddy each emphasize price, geographic reach, and promotion respectively. Shopify sustains its competitive advantage by offering an integrated platform, creating a holistic experience for its merchants, using its network of third-party solution providers. The global e-commerce industry, as you can see from the top, is currently benefiting from a rising trend in online sales and is expected to experience a sales CAGR of 20% through 2020. Using data from the Global Entrepreneurship and Development Institute, we have identified the efficiency-driven stage to be the optimal period for merchants to adopt the Shopify platform and integrate their entire online presence. I'll now pass it off to Kuwar to conduct the financial analysis on Shopify.
Thank you, Omar. Shopify has been penetrating the market at an extremely fast rate with a prospective EBITDA CAGR of 48% from 2018 to 2021. Within our projections, we do believe that Shopify will begin to realize positive profits within the near future, shifting its current return on equity of negative 8.6% to 36.9% by 2021. 2016 proved to be a year where Shopify pursued many strategic integrative deals. And they started off the year with focusing on conversational commerce, then to accelerating the Shopify Plus program, and finally ending it off with creating a fully integrated platform. So initially, conversational commerce was prioritized through the acquisition of Kit CRM, as well as the full integration with Facebook Messenger. These two acquisitions and integrations successfully allowed merchants on the platform to use social media to its full extent as distribution channels and to allow merchants to sell their products off these. Finally, Shopify ended its year off in quarter 4 by integrating with Amazon, providing yet another distribution channel for all merchants.
Thank you, Kor. So right now, let's talk about our valuation. As we know, Shopify's revenue grew 90% for the last year, and we expect them to continue growing at a decreasing rate for the next 6 years. And as we know, Shopify is a high variable cost company. As the result of it, we've taken a conservative approach by letting our cost of goods sold to grow at the same rate as revenue. As the result of it, our gross profit margins stayed the same at 54% for the next 6 years. To verify our buy recommendation, we ran a Monte Carlo simulation where we sensitized risk-free rate, cost of goods sold, and SG&A in our model, and we used a special type of stochastic process called geometric Brownian motion to get our results. And after running the model 100,000 times, we realized that 2/3 of the outcomes recommend a buy, and with 95% confidence level, our stock price won't be below $17. And right now, I'll let Kor talk about the risks that can face our company.
Thank you, Valentin. Investment risks associated with our target price are consolidated within the matrix above. We have further deduced that there are 3 major risks associated with Shopify's operations. These include the foreign exchange volatility, the increase of DDoS and hacking attempts, and finally, the Shopify Plus restructure in payments. Now to reiterate, we issue a buy recommendation on Shopify with a target price of $69.30. This target price is derived through our 4 investment merits. First, the interconnectedness of merchant solutions. Second, the acquisition of new merchant solutions. Third, the persistence in GMV growth. And fourth, the organic growth as a result of our value proposition. Thank you, and we now open the floor to any questions you may have. Thanks so much.
Many of the best ideas are the simplest. They're the ones that make our lives easier, more productive, more enjoyable. In a word, better. Think about what Uber has done for transportation over the last number of years. You can now quickly and easily call for a car, track its progress, pay for it, get your receipt, all quickly and easily from your phone. It's made getting from point A to point B much easier, especially if you're traveling. In much the same way, Shopify is trying to make commerce online for small business users better. So the outlook for Shopify is strong. The outlook for e-commerce sales is strong. The company has a strong brand. We like the story, we like the company, but we don't like the company at the current price of $63. So when we issued our report 6 weeks ago, the stock was trading at $48, and we thought there was about 12% upside based on the intrinsic value of $54. In the interim, the stock has continued to move higher, and last week after fourth quarter results were released, the stock surged more than 10%. Fourth quarter results, however, were largely in line with our expectations. Our forecast for revenue in 2016 was practically dead on, and our forecast for 2017 was in line with management guidance. And while there were modest differences, they weren't sufficient to move our forecast significantly.
The way Shopify generates revenue is simple. Firstly, merchants pay a subscription fee to set up and run the store on the Shopify's platform. Shopify has been very successful in terms of attracting new users. And as the business size goes up, the merchants can choose to upgrade it to a higher priced package. And when the Shopify Plus is the solution for enterprise level subscribers. On top of Shopify's subscription revenue, the merchants can choose to use Shopify's add-on services. Those services include Shopify Payment, Shipping, and Capital, and the POS solutions. Those services are designed to make the merchants' operations smoother and easier so that they can take advantage of the time and use it on business development. And Shopify does share a percentage of the merchant's success by taking a small percentage of the fee based on the sales volume. Together, Shopify's revenue is backed by strong merchant solutions revenue based on have a sticky subscription revenue. And with this addition of Shopify Plus, we believe that Shopify is well positioned to compete in the enterprise level as well.
Our financial analysis starts with a 5-year top-down forecast of the SMB e-commerce market. Based on our assessment of various market research, we expect it to increase 40% by 2021, and Shopify's market share to grow from under 1% to 2% by that same year, leading to a merchant base of 1.2 million in 5 years. For merchant solutions, we expect them to reach 1.6 billion by 2021 based on 4 factors. First, the huge increase in GMV. Second, the increase in GMV per merchant, which is as Shopify merchants become more successful and as Shopify attracts high-volume trading partners to its Shopify Plus plan. Third, as merchants adopt Shopify Payment as their preferred payment method. And fourth, as Shopify creates additional merchant solutions such as shipping and capital. Together, merchant and subscription revenues reach 2.4 billion in 5 years, mainly due 2.4 billion in revenue, 68% of which merchant solutions. The increase in revenues is not matched by the increase in costs and expenses, driving EBITDA margin to 9% in 2021.
So turning to valuation, we, based on the forecast that was just presented, we completed 3 different valuation methods. We started with the DCF, we then went to a transaction-based multiple, and then we concluded with the comparable-based valuation. After having done all these valuations, we concluded that Shopify is best valued based on the enterprise value to revenue ratio. This is primarily because Shopify is, as we've just presented, growing at an extremely fast pace. It's investing quite heavily within its business to drive growth forward. And beyond that, as a result of these 2 things, what's happening is that there's negative earnings in the interim, as well as cash flows are negative over the next little while. We landed at a valuation intrinsic value of $54 based on the peer group multiple of 4.6 times. At the time of the evaluation, as was indicated earlier, the company was trading at roughly $48. Since then, as we all know, the stock price has skyrocketed meaningfully ahead of that. And so we believe that with the current trading range, that there is considerable downside to our intrinsic value estimate of about 10%. And so as a result, we're recommending a sell on Shopify at the moment.
Shopify faces 3 major risk factors, and they have all been effectively mitigated. The first one including expansion execution risk, loss of key personnel risk, and also cybersecurity risk. As you can see, all 3 major operational risks can be effectively mitigated by the management. In conclusion, also to reiterate our investment thesis, Shopify has successfully created a set of interest-leading. Thank you.
If I could just say, having a sell recommendation on the stock that is posting just ridiculous numbers is quite bold, and I do commend you for stating your opinion when the market is really telling you otherwise, what it's thinking, with the stock running up so much. But I have a problem with the immediate sell recommendation, but on the other hand, your forecast for revenue growth is stating that it's going to quadruple or be 5 times in just a few years from now. Wouldn't that scream a buy recommendation? Why is it a sell?
So if I may answer that question,
I think beyond that, if you look at how Shopify has actually been trading over the last while, the company's effectively beat street estimates on a consistent basis. So we look at this company and we say, you know what, if it doesn't beat on a GMV basis or it doesn't beat on a revenue basis, what happens? A company that's consistently been surprising the street, if they weren't to do so, we believe that there's a considerable downside risk associated with the name. I think when you're looking at a name that's growing at a pace as it's been growing over the last little while, that risk is meaningful. The street has been expecting double-digit within the 60%, 70% revenue growth range over the last little while. If it doesn't deliver, we see that there's risk.
And now the winning team of the CFA Institute Research Challenge local final is Waterloo. So I'd like to invite on stage Sophia Chen, Tala Siddiqui, Raj Patel, Judy Dong, and Tanisha Gunasakara. Well done. And I'd also like to commend the faculty advisor, Steve Balaban, the industry mentor, Janine Lee Chong, and I hope that the people that are coming up on the stage realize what has gone before them, and only because it is this team that we can say what we know happened last year for the first time ever is that that our team here won the global competitions in Prague, or they won it last year actually in the U.S. after winning the Americas. So we have high hopes. We'll be cheering you all the way. Well done, and let's hope that that we blaze the trail again. Okay, well done. Congratulations.